What's the best way to pick mutual funds? How many mutual funds do you need to own to be well diversified? And how do you go about buying shares of mutual funds in the first place? We'll answer these questions and more on this, the 26th episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Welcome to day 19 of the 31-day money challenge. Yesterday, we looked at asset allocation, and we talked about sort of a very simple approach to asset allocation. It begins with picking how much you think you should invest in stocks versus bonds, and I gave you some tips on how to do that. And for me, a core portfolio, once you've made that decision, is, of course, you've got whatever percent you decided in a bond, a mutual fund. And then for your stocks, you have some of it in a U.S. stock fund and some of it in a foreign stock fund. And, that sort of three asset classes, I think, is a great core portfolio, great asset allocation. You can add to it, as we talked about. You can add REITs, real estate investment trusts. You can add a small amount of commodities. You can add some emerging markets. And you can even slice and dice your U.S. stocks a little bit, perhaps have a little more in small caps or a little more in a value fund. And we talked about what all those things mean. So if you missed it, I highly recommend you check out episode 25. You'll find that at doughroller.net/podcast 25. Now, today what we're going to do is, okay, we've got our asset allocation plan, whatever that is for you. That's great. Now, how do we go about actually picking the mutual funds? And I can remember when I was getting started out in investing, I knew absolutely nothing about how to do this. And, frankly, as I look back, I certainly made some mistakes. I remember buying some mutual funds that had some front-loaded fees. So, you'd buy the fund and you were immediately out like 5 or 6% just in fees, even before you factor in the expense ratio. And I think that was a big mistake. And I really didn't understand asset allocation, and just picked it up over 20 years of investing and learning and reading and making some mistakes and having some successes, I guess, like anything else in life, right? So today we're going to kind of get down to the nitty-gritty and figure out how we go about picking the funds, the mutual funds that we're going to use to implement our asset allocation plan. Also have a great question from a reader. We're going to cover that as well. So to get started, let me first mention our sponsors who have made this 31-day money challenge possible. The first is Betterment, an online platform that invests your money in both stocks and bonds. Actually, you can also just pick one or the other. My Betterment account just has stocks in it. Anyway, you pick the percentage you want in each. Betterment then invests your money in low-cost ETFs. They rebalance for you automatically, and they also reinvest your dividends. You can check them out at betterment.com. And Personal Capital, it's a free online tool that allows you to aggregate all of your investments, retirement and taxable investments, everything, including 401ks. You can then track your performance. You can compare your performance against like an index like the S&P 500. You can see what fees you're paying across all of your investments, and of course, take a look at your asset allocation across all of your investments. I log into Personal Capital every day. You can check them out at personalcapital.com. Okay, so what we're going to do, let's start with a question that I received from a reader named Bipin, and I hope I'm pronouncing that right, but I'm sure I'll hear about it if I haven't. But here's the question. It's a great question. Is it a good idea to pay off your mortgage sooner if you have money left after saving and investing, or should I put more money into 401k and Betterment/Vanguard index funds? I do 401k contributions, do not max out, but contribute 15% every month. I max out my Roth IRA every year. I contribute $1,000 of savings to Betterment every month. And then in parentheses, my rental income, I gather he has some rental income. And that's where he's generating the $1,000 he puts towards Betterment. I also own Vanguard VTSAX index fund and put money in it once every few months, not automated yet, he says. And then he says, I am 35 years old and I own my home and have $288,000 left on the mortgage and 28 years left on a 30-year fixed mortgage purchase the home in January 2012? Well, first of all, it sounds like they're doing great. I mean, they are firing on all cylinders. I emailed back and forth and confirmed they don't have any other debt. They're just hitting it out of the park. And when I hear a story like this, my initial reaction is, it doesn't really matter. You're doing so well. Pay off the mortgage early if you want. Don't. Particularly if it's a low interest rate, and I confirm that it is. I think it's 3.75%. Pay it off early. Take the Dave Ramsey approach. Don't pay it off early. Take the Rick Edelman approach and invest the money. I would max out the 401k. They weren't quite maxed out on the 401k. I would do that. And then after that, the factors I look at is first liquidity. Once you pay off the mortgage, as you put money towards the mortgage, you can't get it back, right? I mean, you could refinance and do a cash out refi, or you could get a home equity line of credit. But I mean, short of things like that, once you make those extra payments each month, or maybe a lump sum payment once a year, or however you approach it, it's not easy to get back at that money. So I always consider liquidity. It sounds like this person has plenty of liquidity. Again, I don't have all the details, but from what they've shared with us, it sounds like they're doing great and have, that's not a big issue. So what I do, and I'm in a kind of a similar situation. We're down to our mortgage as our last debt, and I take a hybrid approach. I don't put every extra dollar that we get each month into paying off the mortgage. But I do pay it off ahead of schedule. We make extra payments each month. It varies a little bit depending just on how each month goes for us, but I make extra payments. I think if I were to lean one way or the other, I would actually lean towards paying off the mortgage. This is just a great feeling of freedom to have that thing gone. I know mathematically, particularly if you think the stock market's going to do well over the long term, and I do, my interest rate is 3 7/8. If you think about it after taxes, because I get a tax break on that, I'm probably under 3%. Well, surely I'll do better than that in the long run on my stock. So mathematically, it makes sense to never pay that thing off early. Just make the minimum payment for the next 30 years or however long you have left on your mortgage and invest that money. And I recognize that, but there's still that great feeling about having the mortgage paid off. And that's, I guess, the tension between the math of personal finance and the psychology of personal finance. And I think I try to sort of embrace them both. And so that's why I end up doing a little bit of both on our mortgage. And I think for the reader, boy, they could again take either approach or take a hybrid approach and they'd be doing fine. That's my view. So that's our reader question for today. As always, you can send them in at dr@DoughRoller.net. I'm getting a ton of them. I answer everyone. If I've missed you and a couple of days have gone by, don't hesitate to ping me again. It just means that I'm just overwhelmed. That's usually what it means. But I get back to everybody on the emails. So happy to do that and give you my 2 cents worth every penny. Okay, so let's move now to picking mutual funds. I can tell you when I first started investing, I was totally lost. It was nerve-wracking. I had no idea what I was doing. I wanted to invest. I thought mutual funds were the way to go. I wasn't interested in picking individual stocks, but I didn't know. I had no knowledge of asset classes. Didn't have a clue as to how fees would affect my investing performance. I kind of just assumed all mutual funds charged roughly the same thing. I really, when I think back, it's amazing. I was able to make the progress that I have because I was really in the dark. And of course, it was so long ago. We didn't have the internet. It wasn't like I could go to a mutual fund's website to learn information. You had to go into an office somewhere and talk to a banker or talk to a broker. Today, it's much, 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 much easier. And so, what I want to talk about today is one, just sort of conceptually how you should go about picking a mutual fund. What are the questions you should be asking? And then look at in more detail some specific ways to go about it. So to me, when you're going to pick a mutual fund, and this is true, by the way, whether it's you're looking at your 401k and you just have a handful of options, or you're investing outside of your 401k and you can really pick any mutual fund you want. The process is still the same. And the first is you got to know what asset class you're wanting to cover with the mutual fund. If you're wanting to cover your, say, allocation of U.S. stocks, Well, you want to make sure the funds you're looking at invest in U.S. stocks, right? You don't want to pick a fund that sounds good but turns out it invests in emerging markets or commodities. And figuring out what a mutual fund invests in, whether it's U.S. stocks, foreign stocks, large companies, small companies, whatever, is very, very easy. We'll talk about that. But that's sort of the first thing you need to make sure. You're looking at funds that invest in the asset class that you're trying to get some exposure to. And the second thing is, I think it's helpful to going in to know whether you want to invest in a passively managed index fund or an actively managed mutual fund. And let me just cover those terms quickly in case they're new to you. So an actively managed fund is one in which there are, mutual fund managers. They're actually evaluating companies, looking at their financial statements, and selecting which companies they think will do well and investing in those. It's a very active process, and that's where it gets its name, actively managed mutual funds. In contrast, a passively managed index fund, there are no managers evaluating financial statements. They're not trying to pick winners and losers. Instead, the fund is tracking an index like the S&P 500 index, and it simply buys whatever companies are in that index. So it's really just a computer run is how it works today. I mean, a computer makes these decisions to track the index. And so what are the differences between the two apart from that? Well, the first is that index funds tend to be a lot less expensive. The expense ratios are generally a lot lower because you don't have to pay a bunch of security analysts to make all these decisions. You just have effectively a computer program that runs and makes the buy and sell decisions to track the index. So they're typically a lot less expensive. That's the first thing. The second thing is that over the long term, most index funds outperform actively managed funds. In any given year, they may not. It may be, half of the actively managed funds beat the indexes and half of them don't. But over 2, 3, 5, 10, 20, 30, 40 years of investing, index funds will beat actively managed funds. I mean, there's been study after study that shows this. Every now and again, you'll hear about a fund that's outperformed an index for a long period of time. And that usually is big news because it so rarely happens. And here's the thing. Even if we assume that 5 mutual funds over the next 30 years will beat the indexes, how do we know now which 5 that's going to be? We really don't. And the other thing I would say is, even the 5, and I'm just making this number up, it's going to be very few, if any. But even if there are 5 that would, over that 30-year period, there will be times when those funds underperform the index and do very poorly relative to the index. And then how are we going to stick to it? We're going to have doubts. Of course, we're not going to know that over 30, 40 years it will outperform the index. All we're going to see is what's happening at that moment. I think the odds of sticking to that fund are very, very slim, and that's even assuming we could pick the right funds to begin with. So as you might have guessed, I absolutely favor passively managed, low-cost index funds. Now, I'm not an extremist on this point. I tend to take a balanced approach to personal finance and investing. I do own, I'm trying to think, 1 or maybe 2 actively managed funds, largely because of the limited options I have in my 401k. But they've done fine, but the vast majority of our investments are in passively managed index funds. The reason I think it's important to understand how you want to invest, for starters, it will help you narrow the mutual funds that you want to consider. If you, for example, know that you want to stick with index funds. And I think for purposes of this podcast, that's the direction I'm going to go because that's what I invest in. But in any event, so you need to know your asset class. Make sure we've got a mutual fund that covers the right asset class. I think it's important to know if you want an actively managed fund or an index fund. The third thing, and I alluded to this, but fees. You've got to know the fees that the fund charges. You want to keep, in my view, when you look at your portfolio as a whole, given what's available today, I used to want to be at 50 basis points, 0.5% in expense ratio or less as a whole. So in other words, I might have 1 or 2 funds that are more than that. Sometimes, emerging market funds, commodity funds, small cap funds can tend to have slightly higher expense ratios, but then the S&P 500 index funds and large developed country index funds should be a lot cheaper. So when you kind of figured out the weighted average, I always wanted to be below 50 basis points. Today, I really want to be below 25 basis points because it's just so easy to do with index funds. And so that's my goal. And frankly, you want to you keep the fees as low as possible. But I always cringe when people are talking about investments and they talk about such and such a fund they're invested in. I say, oh yeah, what's the expense ratio? And they have absolutely no idea. And here's the thing: it's so easy to determine. And again, I'll show you how to do that. So those are sort of the primary factors that I look at in making investing decisions. Now, I'm a big fan of Vanguard funds. So outside of my 401k, virtually all of my investments are in Vanguard funds, and so that's what I want to focus on today. And so here's what I want to do. As I mentioned, I created a separate screencast, a video. If you go to the show notes of this podcast, again, DoughRoller.net/podcast 26, you'll see the video. I've just embedded it into the blog there. It's a YouTube video, and it's about 10 minutes long. And I did that because a lot of what I'm going to go through, for some it'll be easier just to follow along visually. So you can check out that video if you want. But I'm going to kind of walk through now for those that maybe aren't you're listening on an iPhone or in the car or whatever. Walk through how I would go about picking mutual funds. And I want to, if you've listened to podcast 25, we talked about sort of a core portfolio of some bonds, some U.S. stocks, and some foreign stocks. And again, the percentages of each would depend on the asset allocation plan that you've decided is best for you. So I want to take the U.S. stock allocation piece of that as an example. How would we go about picking a mutual fund for that asset class? Number one, and two, is there an easy way to pick mutual funds for all three asset classes: bonds, U.S. stocks, and foreign stocks? So those are the two things we're going to tackle. And let's start with the easiest one, the one fund solution. There are mutual funds out there that you can invest in one mutual fund, and the fund company will then take your money and put it in 3 or 4 or 5 of their mutual funds for you, so that you get bond exposure, U.S. stock exposure, and international stock exposure. And so that's like the sort of the simplest approach. And Vanguard has, I think all of the major mutual fund companies offer these sort of, I call them one fund solutions. I know Vanguard does. And what they call them for retirement, they call them the Vanguard Target Retirement Fund. And again, I go over this in the screencast if you check out the video in the show notes. And I'll also leave a link to the Vanguard Target Retirement Fund page, so you can check that out as well in the show notes. But it's a very interesting tool that Vanguard offers, even if this is not the direction you want to go, because what it does is it has a bunch of what they call, again, target retirement funds based on your age. So I'm looking at the page now, and for example, if you're 18 to 20, they would have what they call the Target Retirement 2060 Fund, 2060 being the year, roughly, that you would retire, which, man, seems like a long way away. But if you're 18 to 20, you got a long time to go. And it goes through from 18 to 20. It has a category that has the Target Retirement 2055 Fund, 2050 Fund. It works it all the way down to people that are actually retired now, that they have a Target Retirement 2010 Fund. That would for folks that retired in or around 2010. And if you select any one of these, what Vanguard will do is first show you the asset allocation for that fund. So if we select the Target Retirement 2060 Fund, I mean, this is for folks that have got 40, 50 years before they retire. Vanguard, for this fund, will invest your money for you in an allocation of 90% stocks, 10% bonds. And they have some graphs on this page that are very useful, and they have one sort of, I guess, a bar graph, if you will, that has a slider, and you can actually drag it, and it'll show you the allocation, and it will show you how the allocation will change as you get older. See, that's one of the features of this sort of fund. As you get older, Vanguard automatically changes the asset allocation for you, slowly moving some of the money that's in stock funds over to bond funds to get more conservative from now until you retire and even into retirement. And this tool that you can drag this slider and move it to different ages, and the allocations will change automatically and show you how they change over time. The other thing that this will show you is the actual mutual funds that Vanguard will invest in and the percentages in each fund. So for these target retirement funds, Vanguard uses 4 of its key funds. The Total Stock Market Index Fund, which basically invests in all U.S. stocks. Total International Stock Index Fund, which gives you your international exposure. And then 2 bond funds, one that focuses on the U.S. market and one that focuses on the international market. So again, with this kind of option, you just invest in a single Vanguard mutual fund, and then it takes your money and divides it up into these 4 other Vanguard funds for you. And again, as you get older, automatically adjusts your asset allocation. Now, the other thing I would say about these kind of funds is, even though Vanguard breaks them out based on your age, you don't actually have to invest in the one that corresponds with your age, right? It's not like the Vanguard police are going to come over and interrogate you on your age and ask you why you're in the Target Retirement 2050 fund instead of the 2055 fund. If you want a slightly different allocation than what the fund offers that corresponds with your age, you can invest in a different Target Retirement fund. But just keep in mind, with this option, your allocation does change over time. Now, you may be saying, well, I like the idea of a single fund, but I don't really want Vanguard messing with my asset allocation. I want to pick it, and I want to keep it like, whatever allocation you've decided, I want to keep it there until I decide to change it. Well, Vanguard's got an option for that as well. It's called the Life Strategy Fund series. Again, I'll leave a link to this in the show notes. It's also part of the short video that I put together. And they have 4 different funds here that range from very conservative, 20% stocks, 80% bonds, all the way up to more aggressive, 80% stocks, 20% bonds. Same concept. You invest in one fund, and Vanguard takes the money, allocates it over actually the same Vanguard funds that we looked at in the Target Retirement series. But the asset allocation doesn't change. If you want to change your asset allocation, you have to change it. So I wanted to give you this example. I'm using Vanguard as an example. I think all of the major mutual fund companies have very similar one-fund solutions. I know Fidelity does. And a part of this is just to underscore really how easy this can be. It's not complicated. And I think any of these options would be perfectly fine as long as you got the asset allocation that you were comfortable with. Now, some of you may be saying, yeah, that's great, but I want to have a little more control over my asset allocation. I want exposure to commodities, REITs, more exposure to emerging markets. So I want to be able to evaluate individual funds. How do I do that? So, of course, you can go to any mutual fund company website, and they will give you a ton of information about all of their funds. One of the things I like to use, though, is Morningstar. Morningstar really offers a wealth of information about any mutual fund, or for that matter, ETF or stock. And they do, most of the information is totally free. And everything I'm going to talk about today, you can get on Morningstar for free. I do have a premium membership that gives you some access to some fund analysis and other things. But whether you got that or not, just the free information is fabulous. So what you do, and again, visually, I walk through this in the video, but when you go to Morningstar, you can type in the ticker symbol for any mutual fund. I'm going to use the Vanguard 500 Index Fund as an example. Its ticker for its investor class shares is VFINX. You simply put that in the quote box, and up comes a chart, a page with information about that mutual fund. And here's what I like to look at least initially. The first thing is the cost. You got to know the cost of every mutual fund you invest in. And on the main page, you'll see a item that simply says expenses. And for this fund, it's 0.17% or 17 basis points. That's very inexpensive. You would expect that from Vanguard. You would expect that from an S&P 500 index fund. You can actually lower that expense ratio if you invest more. They have different classes of shares. They actually get cheaper, but still 17 basis points is very low. It also shows you the minimum investment. It's $3,000 for investor class shares at Vanguard. If you happen to have this fund available to you in a 401k, there would be no minimum investment, but if you're investing on your own, it's $3,000. And the other thing that's important is what it invests in, right? I mean, in this case, it's kind of easy to figure out. It's a S&P 500 index fund, so we know that's basically large U.S. companies. but not all funds will be that easy to figure out. And so how do you do that? Well, when you go to this page, you'll see there's a portfolio tab. Again, I show you all this in the video. But if you go to the portfolio tab, it brings up a couple of things. The first is the asset allocation of this mutual fund. It'll show you, in this case, virtually everything is invested in U.S. stocks. That's not always the case, right? But in an S&P 500 index fund, that's what you would expect. But it'll show you if it also invests in bonds, non-U.S. stocks. It'll also show you how much the fund has in cash, which is kind of interesting to see. Sometimes you'd be surprised how much some mutual funds keep in cash, and that's a good thing to know. You're not investing in a stock mutual fund so that they can hold a bunch of money in cash. Sometimes they typically hold some amount in cash so that they can pay out folks that are selling their shares, but usually you want to see that pretty low. In the case of the Vanguard 500 Index Fund, they have 0.63% of their assets in cash, which is pretty low. The other thing you'll see on this page, and it's very important, is what's called the holdings style box. It's a box with like a tic-tac-toe board drawn in it. And this is very helpful to get a very quick assessment of what a mutual fund invests in. So in the case of stocks, you can imagine the top three squares going across represent large cap companies, and then the middle three squares represent mid-sized companies, and then the bottom three small companies. In this case, virtually all of the investments are in large companies. Again, you would expect that with an S&P 500 index fund, about 90% of the money is invested in large companies. Roughly 10 or I guess 12% is invested in mid-sized companies. And then there are none of the money is invested in small companies, right? There are no small companies in the S&P 500 index. But that holding style box gives you a real quick way to figure out what kind of companies within the U.S. stock market, in this case, this mutual fund invests in. And then if you look vertically, it'll give you the difference between how much is invested in what they would consider value companies versus growth companies versus a blend of the two. You may remember those terms from our podcast yesterday. And so that's something that I look at as well. And I want to give you just an example of how you might use that style box. So we had our basic core portfolio, right? Bonds, U.S. stocks, international stocks. So now we're focused on just the U.S. stocks. And the question is, well, is an S&P 500 index fund the way to go? Well, what are my alternatives? Well, one alternative, if we're looking at Vanguard funds, is what's called the Vanguard Total Stock Market Index Fund. You say, okay, well, what's the difference between the total stock market index fund and the S&P 500 index fund? And more importantly, what tools can I have to figure that out? Well, you just go to Morningstar. The ticker symbol for the total stock market index investor share class is VTSMX. And if you punch that into Morningstar and you click the portfolio tab and you go down to the holding style box, you'll see a difference. Unlike the S&P 500 index fund, which had no exposure to small caps, the total stock market index has 9% exposure to small companies. So 9% of the funds are invested with companies that Morningstar would classify as small. There's a somewhat larger exposure to mid-sized companies, and then, of course, the exposure to large companies still dominates this fund, but it's not as significant as the S&P 500 index fund. So the first thing this tells you is the difference between what may appear to be fairly similar funds. Of course, then the question is, well, what's right for you? You'll have to answer that for yourself. I can tell you, for me, if I were looking for one mutual fund to cover the U.S. Equities market, I would pick the Total Stock Market Index Fund. I like the exposure to small caps. I like the extra exposure to mid-sized companies. Is it the most important investing decision you'll make? No, probably not. And if someone said, I'm sticking with the S&P 500 Index Fund, that would be fine. I would prefer the exposure to small caps, but of course, you may want to get a little more complicated. You may say, well, I'll take the S&P 500 index fund, and then I'll invest in a separate Vanguard small cap fund. And why would you might want to do that? Well, you may want more exposure to small caps than what the total stock market index fund offers. Again, that's a decision you have to make. You can always keep this simple. You could keep it real simple with a one fund solution. But if you wanted to pick funds for each of the asset classes and you were looking for one for the U.S. stock market, a total stock market index fund, I think is a good way to go. I've looked at the Vanguard option. All of the major mutual fund companies have similar options, so you can check them out. And that's really as simple as it is. You take your asset class, you find the fund that you're interested in. You check it out in Morningstar. I tend to think of it in terms of mutual fund companies. So as you well know, I'm a big fan of Vanguard, so I always start there. And if you go to Vanguard's website, they will show you all of the funds they offer by asset class. So you can look at just the U.S. stock mutual funds, or just the bond mutual funds, or just the international funds, and they give you a wealth of information. If you prefer a different mutual fund company, Fidelity, whatever, they do the same thing. You can research it on their website, and then when you find funds you're interested in, I'd get the ticker symbol from them, come over to Morningstar and check out what Morningstar says about the fund as well. And if you're looking within a 401k and you have limited options, but you can still do this, it's still the same process. Obviously, the universe of funds is defined for you. I guess in some ways that makes it easier, right? Except that you may or may not like the options you have. The options I have are not the greatest in my 401k, but there are some index funds that are available there, and that's what I use. So I hope you found this helpful. As I said, you can email me with questions. Happy to help. And what I'm going to do in the show notes is link to, and I've linked to these before, but I think they're very helpful, to some Boglehead Forum posts that give you example, not only asset allocation plans, but then the Vanguard funds that correspond to those different asset classes. Again, you need to question everything, make sure it's right for you. That is so critical. But I think this information on Bogleheads will give you a really good starting point, and it'll be easy to look. If you have Fidelity instead of Vanguard, it'll be easy to map the Vanguard fund over to a comparable Fidelity fund. Fidelity can help you with that. If you give them a call, feel free to email me, and I'll help you with that as well. Well, that brings our show to a close. Let me get the music going. There we go. I'll have the show notes for this, which are really important to this episode, at DoughRoller.net/podcast 26. As always, you can email me at dr@DoughRoller.net. You can leave a voicemail, speakpipe.com/DoughRoller. You can subscribe to this podcast at DoughRoller.net/iTunes. It redirects you to the iTunes page where this podcast resides. By the way, a lot of reviews are coming in. I really appreciate the reviews, and I'd like to hear from you to see how I'm doing, how I can improve it, the show. So appreciate the reviews and the time that you all have taken to leave them. And lastly, you can sign up for our free weekly newsletter. It goes out every Saturday, packed full of resources and tips to help you make the most of your finances. That's at DoughRoller.net/newsletter. And with that, remember, the best thing money can buy is financial freedom.